Hello everybody, it's the day after FOMC September 2022 and now we have to confront a 4.6% federal funds rate. Eventually, it's quite a big movement from earlier this year. So let's take a look at what happened in 2018, which was the last rate hike cycle and abruptly put to an end in 2019. And let's compare the valuations back then with those of the Singapore REITs in 2022 and let's see what insights we can gain from it. So this is of course the morning after FOMC, and the current rate is at 3% to 3.25%. And if you look at projections, the next meeting, I think the market participants are expecting a 75 basis points raise, quite a fair bit of hike. I think the FOMC surprised me by not hiking 1%. I was expecting them to hike 1% to make a bigger statement to curb inflation, but they only raised by 75 basis points. But then they kind of became more hawkish in the long-term rate expectations. So I think the expectation for rate hikes in the future has raised at the expense of lower than kind of expected hike in September. And if you look at the market participants projection, by June 23, which is mid next year, the Fed funds rates are expected to rise to 4.5%. So from current 3% to 4.5%, we have 1.5% more. So I think people are expecting maybe like two more 75 basis points hike, and maybe like one or two 25 basis points, depending on where you think the FFR will end up. The funny thing though is that if you look at the projections for the December 23, so end of next year, right? People are expecting a median forecast of around 4%. So that means that from June to December, it's probably going to be a 50 basis points cut already. So I think there's a bit of a reflexivity at work, right? By projecting and being more hawkish on a federal funds hike in the future, I think the probability of a recession in the US is becoming stronger and stronger, and the drumbeat for a recession is sounding louder and louder. So, by being hawkish on rates, you're going to send the US economy into a recession, and therefore raising the possibility of rate hikes happening sooner than later. So I think that's what the market is saying. They're going to be hawkish and they raise rates, and then the markets will expect a recession. I think it's probably gonna be a quite a severe one, not a light one, and therefore they're gonna cut rates in the future. If you look at the US corporate actions, it seems to sound so. Look at the tech giants like Meta, and then in Singapore you have C, right? The tech guys are cutting labor, cutting costs, as funding from equity markets dry up, and you have to be self-sufficient on their cash flows. And you see the warnings from big retailers like Walmart and Costco, and then the warnings from the banks. Oh, I think the likelihood of a recession is getting stronger and stronger. So what should we do when we are confronting a 4.6% federal funds rate? Well, it's quite a crazy number, right? If you look at the 2-year US Treasuries, it's at 4% now. And even in Singapore, you see the SSBs hiking up. And actually, if you're interested in the T-bill market, it's also giving you a pretty decent rate right now. So the Fed fund rate evolution has been quite interesting. So this is the past 5-year cycle, and you see the last rate hike cycle, which we are trying to compare with in 2018. So they hike to 2.25 to 2.5% in late 2018. Then in 2019, the Powell pivoted again, reverse course, saying that it's a mistake, and start to cut. And then you have, of course, COVID, right? And then boom, rates went to zero, and now the whole thing is starting all over again. So this is the 10-year treasuries. So it's different from the FFR, right? But in general, it emits kind of similar behavior, right? So the 10-year treasuries peaked out at 3.25% in 2018. That was the last, towards the tail end of the FOMC hikes, and then subsequently they reversed course. And this, of course, the devastation from COVID, and subsequently the rise. What is interesting though is that the 10-year treasuries actually forecast the Fed fund rate Fed cut in 2019. So you see the 10-year Treasuries actually peaked in November of 2018, and the FOMC was actually hiking in December 18, right? Only cutting in 2019. So actually the 10-year Treasuries were going lower. The yields were going lower even before the Fed committee were willing to admit a mistake. So we can see that this guy is actually quite predictive. It can signal a recession earlier than the Fed guys know themselves. And right now it's actually above the previous peak already. For more than 3.5%. And if you look at the 10-year, 2-year US Treasuries, it's at 4% already. Wow, that's incredible, right? So this was what happened in January 19. Powell effectively changed course, saying that the December hike was a miscalculation, and they had to be patient. And in March, they announced a plan to stop their QT. And then things carried on. And then something very interesting happened in September of 2019. So like 1 year after the 9 months after they stopped hiking, there was a chaos in the repo markets as interest rates spiked because of the lack of liquidity. So I think this stuff is really difficult to predict. What happens to the financial markets from moves in interest rates? So you can see the lag, right? They stopped cutting. Sorry, they stopped hiking in 2019, early 2019. But it took 9 months later for there to be a blow up, right, in the repo market. And then after that, the New York Fed Reserve Bank then did stealth QE, right, injected 75 billion of liquidity into the market every morning for the rest of the week. So I think there's a lag between the effect on the markets and what the actions of the Fed is right now. It'll be interesting to see when they hike 75 basis points for 3 or 4 in a row, and then they also do QT. What will happen like 6 to 9 months down the road, right? The effect on liquidity, the effect of market operations, effect of the economy, on recession, on inflation. All this happen with a lag, so it's really difficult to see what's going to happen. This event took me by surprise, that's for sure. This blew up in the overnight repos. So actually, what's interesting though was the break-even inflation expectations. If you look at the 5-year break-even expectations, it's been pretty stable over the past 5 years. In the 2018 period, it was hovering around 2%, going lower than 2%, and of course it was COVID, right? And things just really plummeted. Of course, right? You don't expect inflation when there's a COVID pandemic, right? And in April this year, there was a spike up when inflation expectations were getting out a bit out of control to 3.5%. But since then, with the aggression by the Fed, things are going back to normal. Now it's at 2.5%, so kind of close to the 2% inflation, the long-term expectations, right? And it's probably gonna go even lower if you look at what's happening right now, be it the rental market in the US housing market and consumption effect. If you look at the 5-year forward, it's even more stable, right? So even in April, it went up to only just 2.6%. So I think the long-term expectations are actually pretty well anchored and heading back to norms. So of course, what we want to do is to look at the REITs in 2018, which was the last rate hike cycle, and compare that to now, right? And these are the numbers. So we have these names listed over here, and these are the REITs that I've covered previously. I've left out a couple of REITs for comparison purposes because these have gone through sizable M&As. So for example, CICT, I've left it out because it combined CMT with CCT, and so comparison with that 5 years ago is not very meaningful, right? Same likewise for FLCT, Escort, ESR, and then Mapletree Commercial Trust, all those stuff that have gone through big M&As and mergers. So I've left them out, and these are the remaining ones that I've covered previously, and so I'll just do a comparison, right? So this is the prices of 2018 October. This is the DPU back then. This is the NAV back then, and these are the numbers for September 2022, which is now. The DPU is an estimation though, because it's always hard to predict, right? What's the full year DPU and the DPU next year? But this is my best guess estimates. This is before the impact of rate hikes and before the impact of inflation and utilities and rental reversions and stuff. This is just the current year projections, right? and this is the NAV as of the latest reporting date. And let's look at the valuations now versus then. But before that, these are the prices of September 2022 at 9 a.m. Actually, when I woke up, I thought the REITs market would be a sea of red, but actually it's not. No, it's pretty stable, right? Like nothing much is happening. Which is quite remarkable given the change in expectations. Because I was expecting the 1% hike and then kind of a established long-term hype trajectory. But what the FOMC delivered was 75 basis points and much more hawkish long-term expectations, right? I thought this would have a movement in the prices, but actually things are kind of stable, right? Not really moving much. A bit of pressure, weakness, but you expect it, right? In fact, I was expecting a big collapse and can go in and buy everything at a discount, but actually it's not happening yet. Maybe over the next few days or weeks it will happen. I don't know. It's difficult to predict the financial market. But let's look at the comparison in a better view. But first, the comparison of what I call the big uh, four. Uh, Sanders, Mapletree Industrial, Mapletree Logistics, FCT. I can see that for this big mega caps, big cap REITs, actually it's kind of stable, right? If you look at the prices right now, versus the trough, the bottom in the earlier part of this year, actually a lot of these REITs are still above those in May 2022. So you can see over here, these are the troughs, right? The bottoms. And since then, actually, the markets have not plummeted below the bottoms, which is very surprising given the more aggressions in the rate hikes. I thought the prices of this stuff would be a lot lower already and can buy everything at what 6% yield, 6.5%, 7%. But actually, things are not really happening that way. It's still like a 5+% yield. Just surprising, the market optimism is really very surprising to me. So this is a better view, right, of the comparison, which is the yield and price to book, which is the valuation metrics, right. So look at the DPU alone doesn't tell you much, right. The yield and the PB ratios are more instructive, and I think you can conclude some things. First of all, if you look at the big four of Ascenders, MLT, MIT, KDC, the big four industrials, right. And you compare the yields, so 6.4 to 5.5, 6.4 to 5.3, 6.2 to 5.5, 5.7 versus 5.2. Actually, the yields have compressed quite a fair bit, like 1 percentage points compression, right, from 2018. And similarly for the price to book, it's also gone up by like 0.1, right, across the board. So look at Ascenders 1.15 to 1.23, 104 to 115, 128 to 135, 117 to 144. Especially for KDC, right, you see the jump in the price to book ratio. And this is despite the more hawkish rhetoric from the Fed. So this is really surprising to me, right? The big four industrial REITs are still holding up very well, giving it just a 5% yield handle, right? Very surprising, right? But I think a lot of institutions have flocked into these names for the resilience of the industrial properties and the data centers, right? And if you look at FCT, same thing happened also. Actually, valuations are very stable. In fact, the price to book have gone up. I think this is reasonable though, because this is a play on the recovery of the COVID retail, and some of this guy is all Singapore-based properties, right? And there's a premium, I think, in general for Singapore assets, because it's stable and cap rates are good and stuff. So if you look at CLCT, this stuff is giving you 7% yield, but I think the risk reward is quite balanced, because they give you a kind of a high yield, but also the to compensate for the uncertainty around the Chinese COVID situation, right? If you look at the rest of the stuff here, I think Keppel REIT is also kind of the same as FCT, large Singapore-based assets and stable office, kind of a strong rental growth trajectories. So actually, quite surprisingly, this stuff is still giving you like a 5% only, right? You would think that at this stage, markets will be giving you like a 6%, 6.5% yield for these big names, but actually it's not happening, right? It's a 5%. I find it's kind of low though, the yield in comparison with the yields on the risk-free rate. But I think if you get something like a 6% handle on this yield, people will be very happy to come in and snap them up. And the rest of the stuff, Ames, Suntec, and Star Hill, actually valuations are very stable, right? Look at Ames, 7.5 back then, now it's 7. It's around 1 price to book, right? Star Hill, 6.7 to 6.5, 1.7 price to book. So you can see actually the valuations are very stable for this mid caps. For the large caps, actually they have compressed from 2018 to now, despite the strong rhetoric from the Fed, right? For Suntec, actually, valuations are cheaper. So back then it was 5.2, now it's 6. Price to book is 0.85, and now it's 0.6. But this is for a reason, right? Because I think the balance sheet for Suntec is a bit stretched. So people are expecting the impacts from the rate hikes on the interest cost for this guy. But other than that, for the rest of the guys, actually, you can see that the valuations are actually very, very stable. Very surprising. But again, I think if you get some 6% yield on this stuff, people will be very happy to step them up, I think. Because of the trajectory for rates going forward, right? I think the expectations for recession in the US is very, very strong. So subsequently, you probably have Fed cutting rates already. Of course, it's hard to say, right? All depends on inflation and how it's going to turn out. Another big factor I think is the change in balance sheet of the Fed, right? Look at the balance sheet for the Federal Reserve, right? Prior to COVID, it was 4 trillion US dollars. Now it's 8 trillion, right? Yes, effectively printed double is a monetary supply, right? Monetary base, I mean. And this wall of money flooding the world, and this is just the Fed, right? Look at the BOE, RBA, ECB, throw in China and Japan and Korea and what. Man, the amount of money flowing the market is remarkable. So I think what's gonna happen next is interesting. Certainly a lot of volatility, and whether or not there'll be a good opportunity to pick up some good bargains in the future. Of course, we have to watch inflation as well and what happens in the US, in Ukraine and Russia. So if you have some good picks, good ideas for REITs, leave them in the comments box below, and we can have a lively discussion.